Hey everyone, welcome back to Mental Markets. Today we're going to be going over one of the most important Greeks in option trading, and that will be Delta. We are going to be doing a deep dive into Delta so you can have a full grasp and understanding of what it actually is, why it changes, how it changes, and how much it can really affect your position in the market. Let's use a real world example. Stock price 261, strike price 220. This call option has a delta of 0.83. That means for every $1 the stock moves up, this option should gain about 83 cents or $83 per contract. So if the stock moved up $5, you would expect to make about 415. So again, $1 rise in underlying stock is a 0.83 rise per share. Each contract is 100 shares, would have an $83 rise. That's what delta really is. It's your speedometer. It tells you how fast your option moves compared to the stock itself. A higher delta is going to have a faster rate of change compared to a lower delta. Now take a look toward the bottom of the screen. We have a graph and we are going to be simulating delta in a real life scenario on a real life contract. So delta is not fixed. It constantly changes as the trade plays out. When the stock moves closer to its strike, your delta rises and your option behaves more like stock, more responsive, more powerful. And when price moves away, delta shrinks. Your option slows down, it's still alive, but it reacts less to every tick on screen. Closer to strike, delta increases, and farther away, delta decreases. So what actually makes delta change? There are three main forces: price, time, and volatility. Let's break them down. Price, moneyness, price, as you can see, increasing in price, dramatically increasing in delta. On the left side, on the bottom left of your screen, you can see delta. Price decreasing, and you can see delta decreasing. So the higher the price, the more in the money, the higher the delta will be. The lower the price, the farther out of the money, the lower delta will also be. Stock moves towards your strike, delta increases. It's now more likely that the option finishes in the money. If the stock moves away, delta fades, because that finish line just got farther. And now we also have time that is also going to be changing the way delta is reacting. Currently sitting at 73 DTE, which is just days until expiration. And we're going to move this halfway along here. As you can see, we are sitting at a delta of 0.9 versus with 73 DTE, we have a delta of 0.84 with no other outside factors changing. So as time runs out, the delta becomes more extreme. A lot of the money calls are going to start losing delta increasingly fast. At the money option starts snapping from 0.40 to 80 with tiny price moves. That's why short-term trades feel explosive. Delta reacts faster when there's no time left. So less time, delta is going to be moving extremely quick. You see, here we have just 4 days and it is essentially a 9-9 delta, no matter the price. You would have to be extremely far out of the money to start getting a low delta. With about 39 days to expiration, delta is still moving more quickly, but not as dramatic. Now we are going to be looking at implied volatility. When volatility rises, delta flattens. Everything becomes uncertain. The market is confused. We don't know which way things are going to go. When volatility drops, deltas sharpen. Your in the money calls start acting like shares. Out of the money options lose their life quicker. So as you see, we are currently sitting around a 46-47% IV, implied volatility. Implied volatility go down to about 27%. Delta has dramatically increased. And then implied volatility, the high of the last 52 weeks, has dramatically decreased, now sitting about 0.78 versus 52-week low sitting 0.96. So implied volatility is one of those things people are not paying enough attention to, and it can make dramatic changes in your trade and outcome. That's why it is always good to have a look at IV when you are looking at positions. It's a simple add that you can put beneath your chart. There's one last piece to know: gamma. If delta is your speed, gamma is your acceleration. High gamma means delta changes fast. That's near the money short dated options. Low gamma means delta barely moves. That's deep ITM or long dated contracts. Gamma equals how fast delta is changing. Delta isn't just direction, it's probability. A 0.3 delta option has roughly 30% chance of finishing in the money, whereas a 0.7 delta has roughly 70% probability of finishing in the money. So pros use delta for position sizing. Want higher win rate? Pick higher delta. Want cheaper, riskier setups? Go lower delta. Want balanced exposure? Stay near 0.5. So currently, if you take a peek at my graph, we are sitting at a 0.3638 delta or 0.36 delta. So if the underlying was $1, your contract will be moving $36. So this contract with a 0.36 delta is far cheaper than a contract with a 0.7, 0.8 delta. And the reason for that is you need a far larger move to become in the money. So a 0.3 delta is going to be cheaper, slower, and lower probability. You're going to need a far larger move because delta and gamma is so low to the point, even with time decreasing, days to expiration is nearing, your delta is so far out of the money, it is actually going to decrease. Whereas if you are in the money, your delta is going to increase. So it's not that you can't profit off of a low delta. The odds are just not in your favor. And that's where technical analysis, fundamentals, and finding the right underlying to place a position on comes into play. Because you can get far more contracts for the price. A 0.5 or 0.6 delta is balanced. It's pretty moderate, and you are getting a lower priced contract, but still getting some movement. This is more of a directional play. So we are currently sitting at a 0.61 delta for this contract. This is a 250 strike, same expiration, January 16. It's close to half price of the 220 strike, January 16 contract, but it has a far lower delta. A delta at the money is not going to increase very quickly as it still has an extremely low gamma. You need the stock to rise to start getting gains from delta and gamma and to help your trade become profitable. But you will still, however, see delta increase as the days to expiration lowers. And if stock price rises, let's say 44 days to expiration, you are now sitting with a 0.7 delta. So back to our trade. This call has a delta of 0.83. If the stock jumps $2, you'd expect around $166 gain. But remember, delta is potential, not a promise. If time passes or volatility drops, you'll make less. That's where Theta and Vega start fighting for your profits, and we'll break those down next. So now you know what delta really is. Your option speed, its direction, and its hidden probability. Next up, we'll talk about Theta. The rent you pay every day you hold that position. And if you want to master the hidden math behind options, subscribe, and be sure to tune in to the next video where we're going to be taking deep dives into all the Greeks.